Types of farm accounts. Since farm accounts detail all financial transactions, there are different types of farm accounts for the various transactions. What sort of transactions would a farmer need to record? Consider and discuss. All money coming in and out of the farm should be recorded in the farm accounts. There are 6 common types of farm accounts. The first 3 were discussed earlier, while the latter 3 will be introduced in the following slides. Balance sheet, income statement, profit and loss, cash flow statement, expenditure, purchases, income and sales, and farm valuation. Balance sheet. The balance sheet is the illustration of a farm's assets, as shown in the equation below. Net worth equals assets minus liabilities. You'll learn how to create a balance sheet later in this presentation. Profit and loss. A profit and loss statement, also called an income statement, is prepared at the end of a business period, usually a year. The profit and loss, or P&L account, summarizes the profits, the sales earned, and losses, costs spent, incurred by the farm. The P&L statement allows the farmer to know if the farm is operating profitably or not. You'll learn about how to create a profit and loss account statement later in this presentation. Balance sheet versus P&L statement. If the balance sheet and profit and loss statement both show the assets and liabilities of a farm, why would you prepare both? Discuss. The balance sheet shows the amount of assets, liabilities, and net worth at a moment in time. Those amounts are due to the initial investment plus all subsequent changes. The profit and loss statement shows how and why the net worth is changing. The profit or loss indicates the change in net assets during a time interval, usually a quarter or a year. A profit increases the net worth, while a loss reduces it. Cash flow statement. Cash flow statement shows the details of both income and expenses of the farm over a certain period of time. The cash flow statement is critical for ensuring that the farm has enough cash to meet its requirements at each moment. A farm could have a strong balance sheet and good profits, but go bankrupt for lack of cash if its assets are not liquid, so can't be used to pay bills. Balance sheet, P&L, and cash flow. Together, these first 3 reports provide a snapshot of the farm's assets, liabilities, and net worth at a particular time. Indicate whether the farm can take on liabilities and has the cash flow to handle unexpected challenges or opportunities. Show the structure, nature, and amounts of investments in the farm's various enterprises. The next 3 reports provide the farmer important details to support his decision-making and are used to generate the above 3 reports. Expenditure and purchases. The expenditure and purchases account details the costs associated with the farm. The costs of production and farm inputs are included here. This should include date of purchase, seller's name, quantity purchased, and cost. In agriculture, farm expenses include, but are not limited to, salaries for employees and labor, cost of marketing, processing, transport, advertising, etc., purchase of farm inputs, seeds, agrochemicals, etc., and purchase of capital, land, machinery, etc. Income and sales. The income and sales account is sometimes known as a sales and receipt account. This account details the sales conducted or other income or other money earned generated by the farm. It includes date of sale, customer's name, quantity sold, and selling price. The income and sales account includes the sales of produce, livestock, or products made on the farm. If capital inputs such as land, machines, or tools are sold at a profit, the difference between its current value and the sale price would be included in this account as a gain. Farm valuation. The farm valuation account shows the value of the farm before and after production. At the beginning of the sheet, prior to the production season, the balance is called opening valuation. At the end of production, the balance is the closing valuation. A farm valuation statement details assets and their value. You can determine valuation in 4 ways. 1. Valuation at cost. This is the original cost of the resource. This is helpful when first starting out, but valuation at cost quickly becomes inaccurate as the resources are used. 2. Valuation at market price. Using this method, the assets are valued at the price the market is willing to pay for the resource at the time of valuation. This is helpful, for instance, when valuing land. 3. Valuation at selling cost. This valuation takes into account the cost of selling assets. For example, the value of produce when harvested would not be the value at selling cost. The value is reduced by selling costs such as transportation, advertising, commissions, and bank fees. 4. Valuation at replacement value. Replacement value amounts for the current cost of recreating an asset. This valuation is best for capital assets that are used long term. For example, even if a vehicle purchased years ago originally cost half of what a vehicle purchased now costs, the replacement value of that vehicle is the current cost. The same is true for produce and other goods.